Why aren't there many full-time professional traders? Trading often carries a certain mystique. For many, it conjures images of individuals glued to screens, making rapid decisions, and amassing wealth from the comfort of their desks. Yet, the reality is far more sobering. Very few people succeed as full-time professional traders. The reasons are not merely practical but rooted in the nature of markets, human behavior, and the power of mathematics. The efficient market problem markets, in theory, are highly efficient. The price of a financial asset at any given moment reflects all publicly available information. While there are inefficiencies, pockets of opportunity where mispricings occur, identifying and exploiting them consistently is extraordinarily difficult. The market is a zero-sum game before costs, and after accounting for fees, slippage, and taxes, it becomes negative-sum for the average participant. For instance, imagine a retail trader who notices a recurring pattern in the price of a stock ahead of earnings announcements. By the time they act on this insight, larger institutions with faster execution capabilities and more advanced models have likely already traded on the same information. As a result, the pattern no longer provides an edge. Renaissance Technologies Medallion Fund, for example, thrives by uncovering microscopic inefficiencies, such as statistical anomalies that last for seconds or minutes, which are imperceptible to the average trader. Human psychology. An obstacle human behavior is another formidable barrier. Trading requires rational decision-making under pressure, yet human emotions, fear, greed, and overconfidence, can cloud judgment. This is why even traders who experience early success often falter when faced with prolonged drawdowns or market anomalies. Consider the 2008 financial crisis. Many retail traders, gripped by fear as markets collapsed, sold their holdings at the bottom, locking in massive losses. On the other hand, institutional traders equipped with quantitative models identified opportunities, such as undervalued credit default swaps or distressed equities, and capitalized on them. The ability to act decisively in moments of extreme uncertainty is rare and requires a level of detachment that most individuals struggle to achieve. Moreover, cognitive biases, such as overfitting patterns or the illusion of control, are deeply ingrained in human nature. A trader might develop a strategy that performed exceptionally well during a specific market regime, like the bull market of 2020. However, when conditions change, say, rising interest rates in 2022, that strategy can fail spectacularly, as many momentum-focused traders learned the hard way. The data and technology divide. Another reason for the scarcity of full-time traders is the sheer amount of data and computational power required to uncover meaningful patterns. In the early days of Renaissance Technologies, our approach was simple: use mathematics to extract signals from the chaos of market data. Today, the tools and techniques have grown exponentially more complex, placing independent traders at a significant disadvantage. Take high-frequency trading, HFT, as an example. Firms like Citadel Securities and Virtu Financial invest millions in technology to execute trades in microseconds. A retail trader with a standard brokerage account simply cannot compete with these firms in speed or access to information. Even in less time-sensitive domains, such as statistical arbitrage, the breadth of data required, including obscure datasets like satellite imagery or web traffic analytics, is beyond the reach of most individuals. The allure of the passive approach. Lastly, one must consider the growing awareness of passive investing. Numerous studies have shown that a low-cost index fund often outperforms active trading over the long term. For most individuals, building wealth slowly through diversification and compounding is far less stressful and more effective than attempting to beat the market. For example, during the 2010-2020 period, the S&P 500 delivered an average annual return of approximately 13.6%. Meanwhile, a majority of actively managed funds underperformed this benchmark, even before accounting for their higher fees. For the average person, the effort and risk involved in active trading are rarely worth the potential reward when a passive index fund offers consistent, market-matching returns. So, why do some succeed? Despite these challenges, some individuals and firms succeed spectacularly. The common denominator among them is the systematic application of logic, mathematics, and a relentless focus on data. In my experience, trading is not about gut instincts or following trends, but about solving complex puzzles with rigor and discipline. Success comes from consistency, adaptability, and a willingness to discard failing ideas. For example, Renaissance Technologies' success stems from its ability to combine academic research with practical application. One of our strategies involved analyzing weather patterns to predict agricultural commodity prices. While this might seem obscure, it highlights the level of creativity and precision required to uncover actionable insights. Similarly, Warren Buffett, while not an algorithmic trader, has succeeded through disciplined value investing, focusing on fundamentals rather than market noise. Full-time trading is not for the faint of heart. It requires more than passion, it demands resilience, creativity, and a rigorous scientific mindset. Most importantly, it requires humility, an acknowledgement that markets are smarter than any one person and that success is fleeting without constant innovation. While the dream of full-time trading captivates many, the reality is that the path is narrow, steep, and fraught with failure. For those willing to embrace this challenge with discipline and precision, the rewards can be immense. But for most, the smarter move is to step back, invest passively, and let compounding do its quiet magic over time. Thanks for watching.